Hey guys, this is part 3. In part 3 we're going over how to manage the trade, where to place your stops, where to go put your break even, and where to consider taking profit or allowing the trade to move in order to maximise your profit. Now let's get started.
In this part, we'll be going over how to take the trade and money management. First of all, before we begin, let's go over everything that we've already gone over, just for a quick moment. You should be familiar now with identifying structure on the charts, right? Drawing these structures, and then in part 2 of the video series, we went over identifying the engulfing candles at these structure points in order to have extremely high probability trades. In this part, we'll be going over how to take the trade, whereabouts to start taking profits, where to place your stop once again, and where, as an option, to place a break even. Okay, first of all, let's go over how much is a recommended risk in the Forex market in general. First of all, the recommended for each signal risk with this strategy is 2%. That way, any loss is not a big deal in the early stages getting used to this strategy. Also, 2% is a very low psychological figure. As an example, with a 2% risk, don't think that it's, such a small amount. With a 1 to 2 risk to reward trade, would actually build the trader's account by as much as 4%. As an example, in another profit figure, if you had a 1 to 3 risk reward trade, that would build your account by 6%. So even though it's a small amount, the gain can still be quite high. Now I'll give you some examples of that. For a 2%, if you had a $1,000 account, you'd be risking $20 per trade. If you had a $2,000 account, you'd be risking $40 per trade. And this is an approximation. This is exactly what 2% is. If you had a $5,000 account, right, you'd be risking $100 per trade maximum. Okay, and like I said, that's a recommendation. Right? Okay, so let's move along. Stop losses. There are two options with stop losses. One is below the candle entry, around 10 to 15 pips. The second or above if it's a sell trade. The second object is below the recent low or above the recent high with the sell trade. Both options are sufficient in order to be stopped out only when wrong. And this is the important factor of stop losses. You want to be putting your stop loss in a position where you would definitely be wrong on a position. So this is why we place our stops where the market says where we would definitely be wrong on that signal, and as soon as we'd be wrong on that signal. There's no point in risking too much, and there's no point in risking too little. It's an in-between balance. It's a bit like that story of Goldilocks and Three Bears. One of the porridges is too hot, one of the porridges is too cold, but one of the porridges is actually just right. It's not too hot, it's not too cold. Just like one of the beds is not too... Now, if you haven't read that story, you should go read it, because stop losses are not much different. You don't want too tight of stop losses, you don't want too big of stop losses. You want the just right position, which is below the candle or above the candle in the sell entry, or above the recent high, or below the recent low. Okay, so let's have a look at an example of this. This is an example of a stop loss. As you can see, the stop loss down here, below the low. As you can imagine, if it was above, it would be the opposite way around. Right? Here's the signal entry right here on this chart. Your entry would go above. Okay, that's it for stop losses. Entry, right? As for how you trade this strategy, what I recommend is the best is entering around 9 pips above the signal if it's a buy trade, and entering about 9 pips below the signal if it's a sell trade. Now, when I'm referring to this 9 pip rule, I'm talking about the daily charts, right? Lower time frames such as the H4, it's only a few pips above the signal, like 4 or 5, or a few pips below it in the direction of where you believe the signal's going. And I'll go over in a minute why I think what 9 pips is important, right, on the daily. On the earlier time frames, like the 1 hour, just a couple of pips. Earlier than that, just 1 or 2 pips, like 15 minutes, just 1 or 2 pips above the candle entry. Same goes with the weekly. About a 9 pip entry above the signal or below the signal is a great way of taking the trade. Now, the reason why 9 pips is what I find really effective is because it is a place above the daily candle where if you're buying a pair, the sellers place their stop losses. And we all know what happens in the market when stop losses get hit. The market usually rallies against that, right? So the 9 pip above the daily bullish engulfing candle, if there is stop losses above there, the market moves really well once it breaks above. And the same goes for in the opposing direction if it's a sell. Common areas where people place stops is just above daily highs, daily high of the candles, and daily low of the candles. So we like that position to be taken out before we get into the trade. That way we know the signal is most likely right. And so it's a probability game again, guys. This gives us a high probability of entry for the daily charts, that is. Right? And like I said, about 4 or 5 pips on the H4, a couple of pips on the 1 hour, and just 1 or 2 pips on anything below the 1 hour. Okay? And 9 pips can be used on the weekly as well. So that's for entry. So let's look at an example of that. Okay, so here's the signal, right? To the right here. Here's the entry, about 9 pips above. And here's your stop. Right? Okay, let's move on from that. Okay, the term break even. Now I'm going to go over this from a newbie perspective. The term break even is to mean when you decide you pull your stop loss up above or below your entry price in order to make your trade completely risk-free. So it's basically when your trade goes into the profit zone, a certain amount of pips, it's where you pull your stop up into the profit zone and you let it be. And then you can walk away and you can do your own thing. It's an optional thing. You don't have to set a break even. However, I recommend it highly and I use it in all my trading. With break even, you have 2 options, which I use on a regular basis. First option is a hard break even amount of 40 plus pips. This applies for the daily once again. The second option is to use a break even at body risk candle size in pips. And that's for all the other time frames. Right? And you can use a break even at body risk candle size on the daily as well. And I recommend that. But you can use either option. What you'll find is the smaller break even amount of 40 pips, you will get more break evens. The other option of a break even at the body risk candle size, which I'll show you in a minute, an example of it, you'll get less break evens, but you will get a few more losses. Both methods work well. However, the break However, the hard stop loss will stop loss break even will produce more break even trades overall, and the larger body size risk break even size will produce less break even trades. However, you will get more losses overall when wrong. It's a quick, easy summary on the topic. Let's have a look at this as an example. Here's an example, right? You got the stop loss below, you got the entry above, and you got the 40 pip plus break even. Above showing break even level above 40 pips. Once price gets there, you simply pull your stop loss, which is this one, up to here, to entry price, making the two trades completely risk-free. And you notice I said two trades there because when we take a trade with our signals in the engulfing trader, I recommend taking two positions, and you'll see why. Okay, so this is a stop loss in a down move, and this is the candle body risk size for break even. So this is it's just an estimate, and then look below. That's where you set break even on your two trades. Okay, and I'll go over the reason of why two trades in a moment. So break even is set at the body risk size on both the trades. Okay, above shown an example of setting break even at the candle risk body size. Targets. For targets, what I find works best is taking the first profit at a 1-to-1. That's on your first one trade, because you've got two trades, remember. For the second trade, however, allowing opposing candles to let me know when to get out. Now, what I mean by opposing candles, I mean opposing engulfing candles. Right? This is the engulfing trader strategy. So we know engulfing candles move the market very strongly. So it makes sense that we're waiting for an opposing engulfing candle in order to get out. That way you get some profit after both trades are locked in at break even. Now sometimes the market ranges. So you might get the 1-to-1 and then the market comes back and hits your break even on the second trade. The beauty of this is when that happens, you've still taken some of your profits off. But the other beauty is that you are still allowing the market to let your trade run, and it gives you good risk to reward. This in turn gives you the most reward that you can get from the market, while at the same time limiting risk during ranging markets, which do happen from time to time. Okay, so it's trying to get the benefit from both markets. Here's an example of it. Your stop loss above, right? Like this is the sell signal, candle body risk size for break even, entry, break even. Now, like I said, break even's optional, right? You take profit first position at 1-to-1 risk reward. As you can see, this is about 1-to-1 to this, okay? And the second position, you take profit on second position at opposing engulfing candle close. As you can see, it's right here. Now, let me give you a summary of this chart. Above demonstrating it in action and allowing first trade to be taken at 1-to-1, right? So you're getting some of your profits off, and then allowing the second trade to run until opposing engulfing candle signal. The second trade was more than a 1-to-3 risk to reward, meaning it gave massive rewards simply by letting the trade run. Now, this is one of the secrets to trading in general, trading anything. And in a way, this could be a product in itself, learning money management. This is a very, very valuable tip here, is you have to be able to take some of your profits off because the market ranges sometimes, but then other times it's trending really strongly. And when it's trending really strongly, you want to be able to let your trade run. So this is how you can do it. You take one trade off at 1-to-1. And let me just go back up so you can see this picture again. All right. And let me zoom out a bit so you can see it a bit more in detail. Right. You take your one trade off at 1-to-1. Okay. And then you let the other position run. Now, it could go to 2-to-1. It could come back and it could hit your break even. And if it does, so be it. It could go to a 3-to-1. It could go to a 4-to-1. It could go to a 5-to-1. Heck, it could even go further. That's the beauty of letting your second trade run. Remember, it's risk-free. You're just letting it run, right? And when you get that opposing candle after you've gotten a good amount of pips, you just take profit. Now, you don't want to be greedy. You don't have to be greedy either. You want to let it run as far as you want, as you can. And I've seen trades go as much as 500, 600, 700 pips. So you don't want to be greedy on this. You just let it run. When it gives you the opposing candle, like such as this, you get out of the market at the daily candle close. Now, that's an important subject as well, guys. Always wait for the daily candle to close if you're trading the daily. If you're trading the H4, same. Wait for the candle to close. So every 4 hours. If you're trading the 1 hour, you wait until the 1 hour closes. The candle close is not closed until it's closed. Meaning that near the end, before the candle's closed, the candle can change. Now with the daily candle, it's probably not going to do it in the last 5 to 10, 15 minutes, but certainly it can change in the last couple of hours. And I've seen it happen. So you just wait for the daily candle to close. And this is the beauty of this as well. You only have to check the charts once a day for daily chart trading. For 4-hour chart trading, you only have to check it once every 4 hours. So if you're after a lot of time, with the weekly chart, you only have to check it once a week. Once an hour with the 1 hour. Once every 15 minutes with the 15 minutes. And once every 5 minutes, I guess, with the 5 minutes. And I mean, you do the math. It's the same amount of checking per candle close, really. Right? And this keeps your trading simple, less stressful, and it gives you, it stops you from exiting a market too early. You need to filter out the bad exits as well as the good entries, right? It's one thing to enter the market great, but you need to also look at how can I exit the market at the right time as well. And a lot of people go over all sorts of different strategies, but they never go over exits. They hardly ever go over exits. Yeah, so just take a quick look at this screen again. Just see this. This is the basics of this strategy in play. And in a moment, we'll go to the charts and we'll see it actually on the live charts. I've got some signals pinpointed for you guys and we'll go over it and you'll see it in action and see how it's been working over the charts with structure in play, of course, as well. Okay, let's go over to the charts. Okay, the first chart we'll be starting on is the Euro US dollar daily. And I've got a few signals marked in. Okay, so here's the first signal. This is a bearish engulfing, showing the strategy in play. And here's the stop loss. This is where you'd set your stop loss above the high. Right, once you got the signal, you place your stop above here. This is where you'd be entering the trade. And this is where you'd be taking your first position off. Right? And like I said, if you're using a break even, you'd be taking it off at either the 40 pip, the hard 40 pip, or the body size. And like I said, that's an optional thing. So I'll just be showing the potential on these trades right now. Okay, so the first position, you take off at a 1-to-1, which is about 130 pips, 125 pips. And the second position, you allow it to run until you get an opposing candle. Right? As you can see, we've got an opposing engulfing candle here, a buy candle right here, telling us to get out in the second position. Right. For the second signal, alright, which is a bullish engulfing, here's the signal here. Price went up, and this is where you'd be locking in at. But this is where you'd be taking your first position off, around here, and your second position you would allow to run until you got an opposing engulfing candle, which was right here. right? Now, if you are using break even, like I mentioned earlier on in the video, this would be roughly where you'd be locking in if you were using a 40 pip break even. And this is where you'd be locking in to the body size around here if you're using a body size break even. Okay? Break even on both positions. Now, if you are wondering what break even is once again, break even is just where you pull your stop up into the profit zone, just above your entry price, or below your entry price if it's a bearish move. So here's the third trade, right? Here's your signal. Here's a good valid place to put your stop. Now you can, in this situation, also place your stop above the entry candle. Both are valid stop loss placement areas. And you run the trade down for a 1-to-1 on your first trade. So you're entering two positions, two sell positions in the case of this signal here. Take one of them off at a 1-to-1. The other trade you allow to run, which didn't go much further, it just went to just below there, right here, this bullish engulfing candle, right at structure. All right, let's move on to the next pair. This is a GBP New Zealand daily. All right, we had this bearish engulfing candle signal right here. Right, look left, see the structure. This is where you'd be placing your stop. This is a good valid place to place your stop. You run it down to a 1-to-1 for your first position. The second position you allow it to run until you get an opposing candle, which is what happened right here. Yeah. Now, with the aspect of allowing the second trade to run, you got to see it as, you know, in certain markets it might be a bit choppy. The second trade might come back up and hit your break even. All right, you just have to accept that. That's just, you know, so be it. You know, if it does that. All right, you've already taken half your position off at a 1-to-1. By allowing the second trade to run before you get an opposing engulfing candle, such as this, it allows you to get the most amount of profit from the market while allowing it to move. Yeah? Alright, so let's go on to the next pair. So that was a good sell position, which would have allowed the trader to get 280 on the first position, roughly, and 430 on the second position. Right. The second trade I wanted to go over is on the GBP US daily. The third pair I wanted to go over. Alright, and here's the sell signal, bearish engulfing at structure, resistance structure. Alright, drawn from, like I said, if you're wondering about how to draw these, just go back and watch video 1 again. Okay, so here's the signal. Here's your stop loss area. You place it above the candle entry and above the, you know, because the previous candle is closed, so you place it above that zone. This is where you take one of your first trade off at a 1-to-1, giving you around 130 pips. The second trade you allow to run until you get an opposing candle, which is what happened right here for 350 pips. So your second exit would be here on the candle close here. Now we had a double bottom, bullish engulfing, right? It's a very psychological area. Okay, we had a nice bullish engulfing signal right here. You place your stop below, right? This is around the 148 zone. You place your stop below the signal and the structure. And this is where you would have taken a 1-to-1 on this trade, right? Then you allow the trade to run, and this is where you would have gotten out in the second position. Okay, second, you know, opposing engulfing candle. All right, so let's go on to the next pair. This is the AUD US dollar daily. Right, we had a bit of a structure play, which is price broke above resistance, look left, structure resistance. Then what usually happens, as we went over in part 1 of the video series, price usually bounces back off previous resistance as support. So this was a great place to start looking for buy signals, and we got one right here. All right. Take the first trade off at a 1-to-1, which is about here, and the second trade you allow to run until you get an opposing candle. So this shows an example of a trend trading signal. So the first position you would have gotten just over 100 pips. The second position you would have gotten out at 213. Now the beauty of this is where you were told to get out by the opposing candle and next structure was a good sell candle as well, which, you know, the market went down afterwards. Yeah. And you would have been locked in at break even around here because of the body size. See the body size of that candle risk? And what I mean by body size as well, if you're wondering, is ignore the wicks. You just look at the body of the candle, which would be about here for break even. All right. If you'd used a hard 40 pip break even, I think you would have been, yes, you would have been break even on this candle here. So the body size break even it does work a lot better. Okay. They're both valid break-even levels, but the body size break-even level does work a lot better because you wouldn't have used break-even until about here in this pair. And that you'll find that the body size break-even, you'll hardly ever get break-evens. And that can work on all time frames and all pairs as well. Just be aware that if you're going to be using the larger break even, that you will get more stop losses. Right, so they both have their benefits. Okay, they both have their different benefits. You want, you know, the bigger to break even may give you more stops, you know, stop outs. The smaller break even may give you less losses, but you'll get a lot of more break evens. But they both work really well for preserving capital. And so this signal now is at 1-to-1. You've taken the first position off, and the second trade is now running. You're letting run, which could come down to here, or it could actually get an opposing candle here. We don't know until we look for the daily close of the candle. And so every day you just check it at the daily close. And if you're trading the 4-hour, you check it on the 4-hour close, the candle close. 1 hour, 1 hour. And the numbers go down as you look at different time frames. Okay, so let's move on to the next pair. Next pair is the US Swiss daily, right? Got two signals to show you guys here, right? Here's the signal on this one. This was a bullish structure point, right? You had a bullish engulfing right here. This is your stop below the low. This is a 1-to-1 for your first position. You take off your first trade here, and the second trade you let it run. And where did we let it run to? The next bearish engulfing, which is right here. So about 300 pips. Oh, 290 pips. We then could have taken a sell trade at that level, because you look left, previous resistance structure, and we enter here. We take a 1-to-1 trade off here, which will probably be a little bit less. 1-to-1 trade off here, and then we allow it to run, which would have told us to exit around here or here. Okay, on the Euro AED daily, as you can see, we had a nice bullish engulfing candle signal here. All right, you place your stop below the signal. You enter after the signal, right? You would exit your first position, first take profit around here. And the next trade you would allow to run until you get an opposing candle, which happened right here. All right. Okay, so this is the next signal that you could have taken. This is a sell signal, previous resistance structure on this pair. You place your stop above the signal, right? And this is also a valid stop loss placement here. That's why I've got it here. This would be your entry, just below. This is where you'd take your first position off at a 1-to-1, right? Depending on where how much you're risking. So if you're risking less, you would have been taking it off around here. If you're risking this much, which is what we're showing here, you'd be taking the first position off here. The second position you would be allowing to run, which would mean you would allow to run until you get an opposing engulfing candle. And here's the beauty of this one. We broke the structure low, which means that it allowed us to get more pips, allowing us to get about 470 pips on the second position. Right? Interestingly enough, this was another bullish structure. Right? Got a nice engulfing candle here. Place your stop below the low. And the cycle continues. Price goes up. Take off a 1-to-1 around here. You would have been a smaller profit on the second position. Then you would have been told to, the market told you to sell. We got a sell signal here. And the market went down. But it would have gotten off at a 1-to-1 around here. Alright. Allowing the trade to run, we would have gotten out of the second position here. Now then the market repeated itself again, giving us another buy signal right here. I'll show you this one in detail. Buy engulfing. All right. This being the entry price, allowing it to go to 1-to-1. So 1-to-1 would have been to about here. All right. And then the second trade we would have just gotten out of. If you were taking this opportunity, you would have gotten out in the second trade right now. Right? So you're allowing it to run, the second trade. Okay, let's go on to the next pair. The GBP AUD, UA daily. We got a nice resistance structure here. Nice bearish engulfing at this resistance structure. Here's your entry. Here's your stop loss. Right, price went down. Gave us a good 1-to-1 on the first position. The second trade we allowed it to run, and it didn't tell us to get out until here. So we had a great move down on this pair. As you can see, once again we broke the structure low. Like I said, letting it run has its benefits when the structure low is broken. 430 pips. First position, 213. Right? And like in summary, you know, when we're looking at these structure points in the market, right? And the reason that we use structure as well with the engulfing candle is it gives us exceedingly high probability when trading. And that high probability, you know, means that we are only, you know, most of the time the trades are going to work out really, really well. Yeah. And so that's the double whammer that's, you know, with the engulfing trader. Alright, so as you can see, price went down to here. Gave a nice bullish candle. This could have been a bullish engulfing candle entry at structure. Right? Price went up. And it repeats itself over and over again. Okay, here's the Euro New Zealand daily. We got a nice bullish engulfing candle here. Yeah. Price went up. This is where we would have gotten off at 1-to-1, the first position. Second position we would have allowed to run, and we would have gotten out around here. Now here's a good example because, you know, if we'd entered a sell position here, which looked great, structure resistance, we would have taken a loss on this trade. Right, on this candle. Let me identify it. So this shows an example of, you know, why sticking to the process is so important. Because, you know, we're going to get some losses. Overall, you're going to get more winners, you know, if you stick to the process, and the process will take care of you. All right? But losses are part of the business as well. All right, so not soon long after did we get a nice bearish engulfing candle signal, Here's our entry. Here's our first trade that we take off for a 1-to-1. Would have been locked in at break even around here, right, around this area. Price came down here. Did we get an engulfing candle here? No, we didn't. Telling us to get out? No, we didn't. So we held on until we got an opposing candle, which happened right here. 611 pips at the next structure, right? So overall, 230 pips in the first trade, 602 pips on the second trade, telling us where to get out right here. And interestingly enough, this could have been a buy trade. Price went up at structure. Then we got a sell trade at previous support, becoming resistance, and price went down. Then we got a buy trade at structure again, bullish structure again, got an engulfing candle, place your stop below, enter afterwards. Let me draw this one in for you. All right, entry. Stop loss. 1-to-1 was around here for your first position. Yeah, your second position you're allowed to run until you got an opposing candle, which was right here. Why is it an opposing candle? It's bigger than the previous candle. Okay, you see this little candle here? If you'd waited a little bit longer, you could have gotten out here or here, right? This was the signal to get out. Wasn't it structure, but it was a signal to get out. Wasn't a signal entry. It was a signal exit. Okay, let's go on to the next pair. This is the New Zealand US daily. Okay, previous resistance structure. We've got a good bearish engulfing right here, signal. Entry is below, remember? Stop loss is above. You take off a 1-to-1 position down here. We'd have been locking in break even around here, about halfway down the candle. Right? And the second position, we get out here for about 212 pips and 100 pips. 100 pips in the first trade, 230 pips, and as you can see, this is an engulfing candle, bullish engulfing, and as you can see, close to bullish structure. So good exit spot, right? Not good entry spot because we haven't touched the resistance, the structure support yet. But it's a good exit spot. As a second trade on the New Zealand US, we had a nice bearish engulfing right here. Broke the previous candle low, bigger body. Stop loss was above here. Your entry was here. This is where you took off one position. And your second position now, you would be waiting and watching the daily closes for an opposing engulfing candle, telling you to get out. So we could get one here. Yeah, quite easily. If we got a candle close up above here, looking like this, then that would be an exit on the second position. However, if it breaks below, we'll hold until we get an opposing engulfing candle. Right? And that's on a daily close. Now, if you're using the 4-hour chart, you're trading on the 4-hour, using a 4-hour close. If you're using the 1-hour, you're using the 1-hour close. And as you go down the time frames, you're using the close of the time frame that you are using. Weekly, using weekly. Okay, so let's go on to the next pair. Talking about weekly, here's an example I'm going to give you guys on the weekly chart. Right, and I'll show you the power of this strategy in play on this time frame as well. Okay, so here we go. We've got a nice bearish engulfing candle signal here. Now, this signal risk is about 190 pips. So, just using an example, we would have been locking in break even around here. Yeah? Around here on this pair, about 190 pips, and the market went down. And as you can see, you wouldn't have been stopped out at break even. The market kept going down kept going down until you got an opposing candle down here. So as an example, in summary, right, taking a 1-to-1 trade here for 230 pips. Second trade you allow to run for around 970 pips. Right? Bullish engulfing down here. Now straight away you could take this bullish engulfing. So basically as you close this sell position, you can take this bullish engulfing candle. Right? That's for your 1-to-1. 240 pips. You would have locked in at break even around the top of this first, basically at the end of this first candle close. Right? The second trade, you allow to run, wait, one sec. You allow to run until you get an opposing candle, opposing engulfing candle. We didn't get one here, didn't get one here. We got one here, so you could have exited here, and we got one here. Okay. Okay, so here's another bullish engulfing at structure. As you can see, structure support. Got a bullish engulfing, good entry. Right. Enter above. Exit your first position at a 1-to-1. Right. The second trade you allow to run until you get an opposing candle. We didn't get an opposing engulfing candle all the way up to here a couple of months later for 1600 pips on the second position. Right? So 330 on the first position and 1600 pips plus on the second position. So this shows the power of letting the second trade run once again. Right? Because we could have been expecting a bearish signal here telling us to get out. Right? But it didn't happen. The market just kept going. And that's why waiting for the opposing candle to get out, opposing signal candle to get out, is a really good method. And it works really well. Like I said, the second trade is risk-free already because you've already locked in a break-even. So allow it to run. Okay, let's look at the other. Let's look at the last pair, and then we'll round all this up, this strategy up. Okay, so we had a signal here to a 1-to-1 here, where you would have been locked in at break even by now. You would have been locked in at break even around here, and then the price moved back up and hit the break even the second trade. Good example of the first trade hitting take profit and the second trade hitting break even. Here's another example of that as well. Resistance structure. This is on gold. It's quite choppy sometimes. Had a good sell candle here. Entry afterwards. We took a 1-to-1 on the first position. Then the market retraced back, hit our break even in the second position. Right? And I wanted to give an example of that. So I wanted to show that at the end. And it doesn't happen all the time. It just happens sometimes. Okay, so overall, let's go over this strategy in a nutshell now. In video part 1, we went over identifying and drawing structure. So you guys should be familiar with drawing structure now. In part 2, we went over looking at the candle signal at structure. Right? How to identify the engulfing candle easily. And how to take the engulfing candle. In part 3, we went over how to take the trade, which is the video we're on now. How to execute that trade, where to get in. You know, the only thing different between the daily chart and the other time frames is the daily chart you want to enter about 9 pips beyond the signal. Right, in the direction of the signal. The other time frames you can just enter a few pips above or below. Like as an example with the 4 hour, you can just enter about 3 or 4 pips above. 1 hour, just a couple of pips. And the time frames below that, just a couple of pips. The 9 pip rule for the daily is there because, you know, it's a common place where a lot of people place their stop losses, right, above the signal, or they place their stop losses below the signal. So that's the reason that it works so well and so effective. You know, because when it hits their stops, the market usually keeps heading their way. Also, you want to know that the daily candle is broken above, because that is an added bit of probability. that once the daily candle is broken above, the price will keep going in that direction. It doesn't mean it's going to happen every time, but it's going to happen most of the time. Or if it's broken below, it's usually going to head in that direction below. Okay, and that, as you can see with this strategy, we basically combined the power of structure, right? Understanding the major structures of the daily and weekly chart, which is what we use. Knowing that these places are the areas to take trades, whether you're trading on the daily, 4 hour, 1 hour, doesn't matter what time frame. These are the important structure areas. And then knowing that once you get an engulfing candle, strong engulfing candle at these structure points, taking the trade. And it'll be a high probability trade. Doesn't mean it's going to work every single time though guys. But it's going to work the majority of the time. And then also with the money management, being able to take one trade off at a 1-to-1, which allows you to take some of the profits off when the market is ranging a bit and a little bit choppy. And allowing the second trade to run or to hit your break even. So it hits your break even sometimes. Yeah, that's what happens in choppy markets. In trending markets, however, by allowing it to run, you can see he can get 500, 600, 700 pips on the daily charts. Or if not more, 1600 we saw as an example on the Euro AD weekly. And like I said, before previously, the money management itself could be a product in itself. It's very, 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 very valuable tip in Forex and trading in general. Yeah. So yeah, that's the engulfing trader in a nutshell.
Well, thanks for watching the Engulfing Trader series. If you have any questions or comments, feel free to come over to www.forexreviews.info. And once again, happy trading.